Hello, guys. Welcome to the afternoon in the UK. Anyway, make sure I'm sharing my screen here. Sorry, that was quite tight on time, I have to say. Here we go. Let's just change this template off. And we'll have a look around the market and see what we've got. It's a bit of a tepid one, really. There has been some movement in the stocks, but nothing that you can really rely on as an overall kind of catalyst for a change of direction. So it's probably more of a buying opportunity if stocks are sold off. But I'll show you what the situation is here, because hold on one second. I'm not. I have to make sure I'm live here. Here we go. We are live, aren't we, Mai? I can't find the live show on YouTube here. Okay, I'm going. We are okay. All right. I can't see your questions. Hey, John, how you doing, buddy? So we're going to be looking at stocks later on, and start to learn about how to pick and read the stock market and some of the numbers as well in the stock market. And I will also just touch a bit on the COT data as well for you, Subra. I know you were asking about on Monday, so I'll touch on some of that, and I will go into the stocks as well later on. But let's have a quick look around the ground. Let's have a look at some of the data points that we've had so far, and see what's been released and what is to be released. Where have you gone, Forex Factory? Still set while we were analysing the yen. Here we go. So let's just go to the week that was so far, and have a look. So Euroflash PMI. Now we did talk about this on Monday, but you can see that the numbers are quite weak. What we'll do is we'll have a look at the numbers, and we'll just see how they ended up playing out. So French services PMI came in weaker than expected. Much weaker than expected. Most notably, is really about the change between these two numbers. So the weakness itself, as forecast, is not that important, but you can see that the PMI numbers. So this is the Purchasing Managers Index, and the Purchasing Managers Index really gives the market a snapshot into price points that the purchasing managers are seeing, happen with certain goods and services, and then all of those goods and services are bundled in together that fall under the PMI numbers, and an aggregate is formed, and then we just kind of get a read on whether those PMI figures are growing or they are weakening, and anything above 50 is seen as growth. Anything below 50 is seen as weakness. So if we go back historically and have a look at these PMI numbers, then you can see that the pandemic caused a huge shock to the downside, because they don't spend a lot of time in negative territory. Here we see a really sticky period through 2011 to 2013 for French services PMI, and you wouldn't take just one number as a metric alone. You'd want a kind of group of numbers, but this is an important one, and most of them, to be fair, that are important ones are in red. You will see other numbers that they don't deem as important, which are important, which are in orange and yellow folders, but the red ones are pretty much all important. So we see that here, the expansion, and this is about expansion, is not about whether the French economy is in recession. Let's say, recession. We want to see 2 quarters of weakening GDP in negative territory. to show us a recession. But with the PMI data, this can precede some of that. But you can see this is the financial crash 2009, and then we start to build up. So when these numbers pop up and they end up being very impressive, it's relative to where it came from. It's not really showing. It's showing us that there is growth relative to what happened prior, not historical. It's not historical growth per se. It's just month over month growth. So we can see month over month, the French economy looks like it is weakening. Now that isn't a huge surprise. You know, we've got the global pandemic, and with the global pandemic still quite prevalent and obviously still raging in certain parts of the world. Oh, here we go. Sorry, I didn't see. I've just seen the questions. Fat, I am doing great, mate. Oh, well done, John. That's really good that you're saving money from bad trading decisions. Well, there's a lot of questions here, a lot of stuff here. Good evening to you, John. Good evening to Subra. Is the budget review today or tomorrow? I know that there was something reported today. We'll have a look. Did I buy gold? I haven't yet. And I'll show you what I want with gold, but I haven't bought it yet. Now with gold, when we talk about these stocks, I will show you what the situation is with. I probably will buy some physical gold, but what I'm really interested in is, can I pick up gold on a stock? And the reason for that is that the stock will pay a dividend. Yes, it was my target to go long. You're absolutely right. It's the upper end of my target, however. It's not the lower end of my target. You know, I'll show you. So when I'm looking at gold, when I look at gold, what I'm looking at here on the monthly, you're absolutely right. You know, this is an area that we could start to look at the long, and we'll talk about reasons in a moment why I don't think we've flushed out enough to the downside. So yes, you're absolutely right. You know, this is an area that we could start to think about the long, but is it ready to go long? And it might even end up being this price. So you know, the long might be at this price. That is more than possible. That we could start thinking about the long here, but firstly I want to see more price action, but secondly and more pertinently, I want to see something with the fundamentals, which we'll talk about in a moment. But yeah, exactly. Fad's just mentioning that the seasonals point bearish until early December. So if we just you know, I was going to touch on that later, but let's touch on that now, and some of the reasons why I wouldn't go long gold just yet. Where are we? I've got to bring in my here we go. Right, let's have a look at the let's look at the COT report with gold, and we'll look at the seasonal data with gold as well, and we'll cover a little bit of information about the COT data. But this stops me going long on gold at this particular time. Tell you what, we'll let that load on another screen, and when it's loaded, I'll bring it in. Now, when the likelihood that gold flips in the opposite direction comes into play, then I will look at going long gold. Now, the dollar is continuously weak. It's in terrible shape. I've got an issue with gold though, because yes, so you got Thanksgiving as well. You're absolutely right, Fad. I mean, and all these factors have to play a part in our decision making. So Thanksgiving is this weekend, and it's an event. You know, this Shukri was telling us that that markets tend to run to the upside, you know, during the Thanksgiving break, and that's one of the reasons I wouldn't go short on those, even though I'd quite like a short on the FTSE to a degree. I was looking at that yesterday. But let's have a look at the seasonals with gold. Now, we're trading gold against the dollar. The dollar index is still showing, there's a few things here actually. Dollar index is still showing seasonal upside. Now, the dollar is in terrible trouble. It continues to underperform. But this is what the situation is with the dollar. Now, the dollar suggests, according to this, so this is this little word down here, which you may or may not be able to see. I don't know what kind of screen resolution you're getting. But down here, this is October and this is November. Now, October and November. So we are looking for probably the last week, and it does suggest that the dollar index is suggesting that we might start to get some downside. Now, what's happening here with the arrow? It's telling us day over day. You know, so is today an update, generally speaking, or a down day? And it tends to be an up day anyway. So we could start weakening into Christmas. Then we have a little bit of a run to the upside, and then we really start to move down around about mid-December. So mid-December is the first point of call because we're trading it against the dollar. Now the next one is, what is the COT data suggesting in regards to the commercials? Just the commercials. Nothing else. But what the COT data at this particular stage is suggesting, when we look at the dollar, sorry, this is the this is the green line on the dollar here. There. Yeah, there's the green one on the dollar. Now, when we look at the dollar, the commercials here, this is suggesting that they are long dollar. Now we're going to talk about the COT data in a little while, but this is suggesting that they're long dollar. When the number's over 50, it's suggesting upside. When it's under 50, it's suggesting downside. Extremes are at 100 and 0. So extremes to the upside will be 100, so very, very long, and extremes to the downside will be 0. And really anything that kind of goes above 90 is when we start to pay interest, and under 10 we start to pay interest as well. So you can see here that the yen here is under 5. Within 18 months, it's under 8. But actually, the closest data is suggesting that the yen, in regards to the commercials, are still, you know, that they haven't fully committed to the short side to sell it off just yet. A little bit different with the New Zealand dollar. You can see that they're very committed to downside in the short term and less so in the medium to long term. So the dollar at this stage is suggesting upside. That's the first thing we need to note, because we're trading gold against the dollar. So that's not suggesting that we would have our timing right in accordance to these. Now, let's bring up gold itself. And what are the commercials suggesting in gold at this stage? Well, they're not really that committed. Not committed over a 3-year period. They're not committed over an 18-month period, and they're not committed over a 6-month period. In actual fact, if anything, they're a little bit bearish there. They're kind of bearish to flat there. Bearish to flat there, and they're a little bit bearish there. So the commercial information hasn't changed sufficiently to suggest that the bulls have come back in when it comes down to the commercials of gold. And when it comes down to some of these commodities, I find the COT data a bit more trustworthy than many other things as well. So I really like that. We'll look at it in a bit more detail in a moment, but that's what that's particularly suggesting there. Now, if we look at the non-commercials. The non-commercials are on the other side of the market, but they are not particularly. Actually, that's not the full thing there, but they're not. They're not really. They're not particularly heavy on buying gold at this stage either. Only a 4% change there. No different from last week as well. So these will be on the other side of the market. So if gold is coming down, then these guys were, and the commercials are selling. These guys are going to be on the other side of the market, and they'll start buying, but they haven't really shown any commitment to buy just yet. Now let's look at the seasonal pattern. And the seasonals on gold are suggesting that we have a weak rally if we look at the historical data, but the weighted data is quite flat. But then we start to move to the downside again. So what could happen? We could get a little rally and then go down again. And this kind of leads us to the middle of December before we get a really good run in gold right the way up to the middle of, looks like the middle of, well, near the end of March, let's call it. There is a little dip here, but not in accordance to the weighted average. So the weighted average suggests that we're going to get it around about the middle of March. So this is the best time to be buying gold in accordance to these. Now, that doesn't mean that we have to wait for that, and that doesn't mean that this gives us a reason to buy gold at that particular time, because the external factors will trump this every time. So the other thing we got to ask ourselves is, what is driving gold lower? Because if the dollar, if we look at the dollar, John's just saying, is the dollar weak over the Christmas period, so it draws in more travelers who will spend the cash shopping? Because this time around, is the dollar weak over? No, that won't be. They won't. They wouldn't manipulate it like that, John. They wouldn't be able to. I don't think the dollar is weak because the Federal Reserve have printed so much of them, and it's a simple supply and demand story, really. And I suppose inevitably the dollar is going to be the weakest in some respects, because what's happened is that, so you got the kind of central bank here, and they've just made lots and lots of dollars, multiple amounts of dollars, and the supply has just multiplied. So there's just there's lots and lots of these dollars all over the place, and the supply is just multiplied, and inevitably when something multiplies in supply, it devalues it. If you've got a guy kind of over here, and he's got his little shop, and that shop is selling whatever, really. If it's selling let's say apples, no, let's say bikes, actually. He's selling his bikes over here, and somebody else then all of a sudden comes in and opens up a shop next door, then and he's selling bikes, or she's selling bikes as well over here. Sorry, very bad bikes. And they're selling bikes as well. Then it almost becomes like a price war, because you've got more supply. So as soon as you increase the supply of anything, then the price will tend to drop of the products. And so it is just, with the dollar, it's just a simple kind of supply and demand story. The Fed continued to they lowered interest rates, and then went on a big bond buying program. And if people don't understand what that means, they purchase government debt. So they and with that purchase, they obviously sort of like give the market much more of a supply of dollars. So that's what quantitative easing is, where they buy a lot of government debt, and while purchasing it, they're printing. They go in the background, they print a load of money, so it doesn't cost them anything, and then they go and buy the government debt, but it means that they pump the market with more liquidity. So here's the thing, Fad, and this is a good point. So when the dollar is weak, won't people be buying gold, since the price of gold is cheaper? Yeah. So the gold, and this is what we've got to work out. And as soon as we work this part out, then we'll know when to buy gold. Why does gold move at all? And the thing is with gold, so gold is a store, effectively, is a storage of wealth. And the reason that gold is a storage of wealth is that it's finite, and it will usually be a hedge against inflation. And what that means is, if all of a sudden the central bank start to raise inflation. So I don't know where they are in every country in the world, but if the dollar is currently, if the US government is currently got a 0.25 inflation, and then all of a sudden they put it up to 3, that means the price of goods has gone up by 3% on average. And this is what the PMI and the CPI, which we just looked at. This is what this is all gauging. What's the price of goods? How have that moved? If the price of goods goes up by 3%, then gold will tend to go up as well. So things like housing becomes more expensive. So everything starts becoming more expensive. So gold becomes a hedge against inflation, because it will track in inflation better than most things. So while inflation's going up, gold will tend to go up. However, what is happening right now is that the inflation is not coming. We haven't had inflation. We're in a if anything, we're kind of flat when it comes down to the price of goods. They haven't jumped in the way that people think, but with the amount of dollars in the markets, the one way that that the government can make sure that they control the price of things is by raising interest rates. And when we see the interest rate rise, then this is when people tend to look at gold and use it as a safe haven. So people will buy gold since the price of gold is also cheaper. People will buy gold when the price is cheap enough, for sure. And they will use it as a hedge against inflation. But why has gold moved from here so far? Why has it moved from there to there? Why did it move from October, if you like, or even June 2015 to this price? How did it get there? What happened during the pandemic? This happened with gold during the pandemic. Protection. Now, this is the thing that we need to discover. Why is gold coming down right now? And there's a chance, if we think about what's happened over this month, this is the breakdown bar. This other stuff could just people taking profit because you've got a level that was provided over here in 2011. So people just taking profit of these somewhere in this area. But why is it breaking down? And if the breakdown is due to people feeling more confident about the pandemic, meaning that they don't feel like they need so much protection against another market crash, then this will come down as long as that is the driver. As long as that remains the driver, and then when we go into a different set of parameters, then we'll see new drivers. But what we need to be looking for, and what will provide us to buy gold, is the print of things like CPI, because with the CPI or the or the PMIs and stuff like that. Because the thing with the CPI is this is giving us a gauge of inflation. And gold is traditionally, and you can look this up, but gold is traditionally seen as, amongst other things, a hedge against inflation. So if inflation starts to increase substantially, then the price of gold will likely go higher. Now, that hasn't really happened yet. So it hasn't got a driver there. The pandemic as with a risk factor, it seems to be abating to a degree, so it hasn't got a driver there. So at this stage, there's no real driver. Now, if we're considering why we would buy gold, and let's take away the mistake of buying gold because it's hit a price point on a chart. There's the only time the only time that I would buy something because it's hit a price point on a chart is that the fundamental that the reason that you either bought or sold it in the first place still exists. So then you're looking at the price action to try and get a good price. But the question is, does the thing that has driven gold, particularly during the half of the year that we're in, this point to this point, the thing that drove gold from there to there, does it still exist? Well, it hasn't really. Deflation is something. So all of them are bad, but the thing about deflation and inflation and stagflation effectively is that it's about extremes. So deflation isn't bad if the economy needs it. If the economy needs deflationary environment, then it's a good thing in some respects, but it's not something that can be sustained. Inflation getting out of control can't be sustained, which is why the central banks step in. And the central banks step in and control inflation. So if the central bank's main purpose is to provide as close to full employment as they can in every single country, and to control prices, so things don't get too far out of hand, and they will use a set of tools to do that. controlling prices means that they don't want deflation because it means that the price of your assets are always going down, and that's not good for prices of assets to go down. So they need inflation, but it's got to be good inflation. Will inflation eat up? Yes, it will. Inflation will eventually eat up the oversupply of dollars. Yeah, and we can talk about that as well because if you consider what the problem that the central bank have got, this really goes right back to and where the discussion really needs to start from, and it really needs to start from 2009. Because what happened was the stock market crashed. The stock market just had just did that, and the way that the Federal Reserve reacted was to lower interest rates. So that's the first thing they do when you see some asset prices fall, they lower interest rates. And then they have QE. And what QE is buying government debts. I mean, there's it's a bond buying program, but that doesn't really tell you what's going on. QE is effectively the central bank buying up debt. Now they will get a return on their debt. They'll it's like it's basically the reason that it's like a bond buying program is that different ways that companies, and this is where companies and countries kind of have a link, if you like, a way. So let's think about a country, and we'll sort of like think about it in the same way that we'd have a there's a really bad map of the UK. So if you've got the UK, and we'll think of it as a company instead. One way that it can raise money to invest, and this is what what every country is trying to do, progress, and like every company is trying to do, they're trying to progress. One way they can raise money is by issuing shares in the product of that of the company's profits. Now, countries can't issue shares, but what they can do is issue bonds, and the bond. So while a country issues a bond, the bond is a treasury bill in the United States, and in this country, they're called a gilt. So a bond and a gilt are the same thing, and in Germany, they call them bunds, and so a bond, a gilt, a bund, a treasury bill. These are all the same thing, and it's just basically a country offering a bond where whoever it is, and it's normally a central bank over here, the bank. But it's the central bank of the company will go and buy one of these gilts or a whole bunch of these gilts, and they will have an interest rate on that. So the UK government might say, we'll sell you a 30-year gilt, and for buying that debt, we'll send you a 30-year gilt, and let's say that the central bank come in and say, okay, well we'll buy 1 billion of these every month on a monthly basis. Then for the central bank's purchase of that, then the UK government will pay back interest of, I don't know, 1.25% or something. It's probably not as high as that. So they'll pay interest back to the central bank. So the central bank makes money. This is why when people say about who runs America, this is why we know it's the Fed, because the Fed, if you think about it, if you own the debt of any company, you really do own the company. You're controlling everything. So when the central bank owns the debt of a country, they own the country. Right. Well, we will continue this discussion. I will just thank the guys for popping into YouTube. I don't know if anybody's there actually because I can't see, but if there are anybody out there, then I hope you enjoyed that half hour. And I will see you tomorrow with Geoff. For everyone else, stay on the line. I'm going to play a quick tune, and then I know what I'll play today. I think.